Hello and welcome to Trusts 103. So let me tell you what you've learned about in Trusts 101 and Trust 102. So first of all, in Trust 101 we talked about the general history of trusts, where they came from, and we did the worked example where I gave you $100,000 but I didn't want to give it to you because I didn't trust that you were going to spend it correctly, so I made sure that I gave it to someone else who then managed it on your behalf. So remember, that was the worked example of what a trust is, how it actually goes about working, and also its history and its origin from the UK and the US. And then in Trust 102 we talked about the different types of trust. So in here we talked about family trusts, discretionary trusts, fixed trusts, hybrid trusts, and also blind trusts. So those were the different types of trusts that we were likely to see across the board. In this lesson, you will be taught the general taxation treatment of trusts. So we just want to know how the tax office grab what they need to grab from a trust, where the actual income gets taxed at. And so by the end of this lesson, you'll be able to understand where the tax office get their share of the income that's earned from a trust, what happens with capital distributions and capital gains and other bits and pieces. We're not going to go into this really deep because I'll do that in a different video that I'll show you the actual trust tax return. But first of all, we're just doing overviews here in the 1.0 section of our training. So this is, without further ado, Trust 103, Taxation of Trusts Overview. Okay, so the important principle to remember when it comes to the taxation of trusts is that if the trustee doesn't distribute the income, then the trustee is generally liable to be taxed on that income at the highest marginal tax rate. Whoa, what does all that mean? That just means that there's a very big financial incentive from a tax perspective to make sure that all of the income is distributed to the unit holders in a unit trust or to the beneficiaries in a discretionary trust. Let's talk about the unit trust first, because that's nice and simple. So if a trust earns $100,000 worth of assessable income, so we've got our taxable income less our allowable deductions equaling our assessable income. Let's say, for argument's sake, we've invested the original $100,000 in my story, and instead of distributing it to you, it's earned $10,000 worth of interest income. So we'll just call it, make it nice and simple. Now, if the trustee says, well, you know what, I'm not going to distribute that income to anyone, I'm going to leave it, I'm going to be taxed on it by myself, the trustee is going to end up paying around about in Australia 50 cents in the dollar. So they're going to pay $5,000 worth of tax on the $10,000 worth of interest income. If, however, they put the $10,000 worth of interest income to the beneficiary, in this case you will pay tax at your marginal tax rates on that $10,000. So you might have other income, or you might have no other income. Now, if you didn't have any other income and you were over 18, then the $10,000 would be under the tax-free threshold, and therefore you wouldn't pay any tax on that income. So the difference could be as big as I pay no tax, right up to I pay 50% tax. So it's very important from the general overview of trusts that the trustee gets the distributions right in terms of the income tax liability. Now, here's a tricky part, because the distribution that happens of income and capital can be different from the assessable income that's distributed, and then we've got other complexities in things like franking credits. So let's not get too worried about that. Let's just stick with the overall principles for the purposes of this class. Okay, so let's take our example. I'll use a different pen, of our unit trust. So our unit trust, now it earns, I'm going to say $10,000 worth of interest income. So $10,000 worth of interest income that it's earned for the year. So the trustee, unit trusts are usually, the trustee is usually a company. So let's say the company is XYZ Pty Ltd is the trustee of the unit trust, and we'll call this the Scott Unit Trust. and it was $10,000 worth of interest. So it's interest income. If the trustee decides not to distribute that to the unit holders, then it will be assessed on the $10,000 under the highest marginal tax rate. So it would be around about $5,000 worth of tax to pay if it didn't distribute. If it does distribute, it won't pay any tax. The trustee won't pay any tax, and the trust itself doesn't pay tax. The trustee is never a taxable entity. It's either the trustee that gets assessed, or it's the beneficiaries or the unit holders. In this case, I might have Joe and Sam. Joe owns 60% of the units, and Sam owns 40% of the units, in which case Joe will get distributed $6,000 worth of income. Sam will get distributed $4,000 worth of income. Now, how much tax do we pay on the $6,000 or the $4,000? Now, if you're answering this question out loud, I would put it to you that you're actually talking to a video, but notwithstanding that, so I'll jump right in. We can't answer that question because we don't know what other income Joe's got and we don't know what other income Sam's got. So it will depend upon what their marginal tax rates are. But their top marginal tax rate would be 50 cents in the dollar, so the most tax that they would pay would be $5,000 between them if they had a lot of other income. Typically they would have a lot less income and they'll be paying a lot less tax. But we can't answer the question how much tax will be paid on the $10,000 if it's distributed out. Discretionary trusts work very much the same way, except, so if we call this the Scott Family Trust, and remember, the family trust is just another name for the discretionary trust because most family trusts are discretionary trusts. It's the same example, except I won't have a company trustee. I'll have my brother Brett is the trustee. Brett, as trustee for the Scott Family Trust, $10,000 worth of interest that the trust has earned. So Brett needs to distribute. Now the beneficiaries might be Scott, Kerry, Reese, Kane. Let's call it a super fund because I want to talk to you about this. And let's call it also you. Presuming you're not in my direct family. So these might be all possible family beneficiaries. These two aren't. So the trustee can say, okay, well, Scott earned a lot of money this year. Yay, me. So we're not going to give him any of the $10,000. Kerry earned, a little bit of money, so we might give her $9,000 because that's going to give us the best tax position when we look at her marginal tax rate. Now, Reese and Kane, this is a special example of these guys are both minors. They're under 18 and they didn't earn this income. So if they get distributed income because they're under 18 and they're not working, they'll get taxed at a higher penalty rate, which is actually about 68%. So the most we can give Reese and Kane is the maximum amount that you're allowed to give for minors, which is around about $420. Not a lot, is it? We might give them $420 each worth of assessable income. So the tax on that would be nil. Tax on that would be nil. The tax on the $9,000 we don't know. It depends on what else Kerry earned, and of course that's all. I didn't get any in my example. If my brother decided to distribute the money to a super fund, It's a problem because the super funds pay tax at 15 cents in the dollar or sometimes at 30 cents in the dollar, but typically the super funds will pay tax at a tax advantaged rate. So the $10,000 paid to a super fund is going to cause a problem because it's called accepted income, and the super fund's going to end up paying tax at the top marginal tax rate because, again, it's just the tax office trying to be fair. So you would never distribute a discretionary trust to a super fund. Similarly, but kind of different, because this is a family trust, a couple of things can happen. Now the family, and I'll explain this in a bit more technical detail. In fact, I'll put this up here to remind me to talk about this for later on. If you distribute outside, and I'll explain why, but if you distribute outside of the family group, then, which might be to you, then again it's a problem because the trustee won't be allowed to do that. So in which case it'll revert, if the tax office ever looked at it, it would revert back to the trustee who would have to pay the tax. Now don't fret, this trustee who's having to pay all the tax, the trustee's got what's known as a right of indemnity over the assets of the trust for any liability that the trustee incurs, which means that if the trustee gets assessed, he'll take the money out of the trust. So eventually the trust does pay, it's just that the trust itself can never have an assessment against it. So that's generally the principle. So the principle is the trustee at the end of the year distributes all of the income out to either the unit holders or the beneficiaries. If it doesn't do that, it's going to pay tax at the top marginal tax rate. So there's usually a very good reason that it would. I don't want to go into the technical details of things like imputation credits and capital gains tax and how that gets worked through just yet. I'll do that in the next, which will be the 104 series. So, in this lesson, you have been taught the general taxation of trusts. You have learned what happens if the trustee doesn't distribute all of the income, what the likely tax scenario is. You have learned about the distributions of income in a fixed trust or unit trust, and you've learned about the distributions of income in a family trust. If you have any questions, please don't hesitate to reach out and contact me. That's all. Thank you very much. I don't know why.